Hey everybody, welcome to Financial Thing, Thursday evening live stream, investment live stream. Thanks for everybody for joining and listening to me natter on with our special guest who we have this evening. I'll bring him on it in a second. We're going to be talking peer-to-peer lending tonight. Usually we tend to flip-flop back and forth, do some of that with the stocks and cryptocurrency, and you've probably seen the big news today. Everybody's thinking that the Bitcoin is completely crashing, but no fear there, in my opinion. This is just all noise, and everything is going to be just fine with Bitcoin in the long run, but that's for a different stream. And tonight we have Blend Network CEO Yann Marciano. I always afraid I'm going to butcher his name, but if you have questions for Yann, put them in the comments, and we'll go ahead and get to them towards the end of the stream. So hang out, make sure you watch the whole thing. I always have a good time chatting with Yann because he's very transparent and he's very knowledgeable in the field. So let's bring on Yann and see what's going on over at Blend Network and get his views on the peer-to-peer industry in general. There he is, the man himself, coming direct from... where are you right now? Where are you located?
I'm in the office in Marylebone.
In Marylebone.
Mm-hmm.
In Marylebone. Okay. Because last time I came to visit you, were you in a different place? Did you move
Right. We're in Maddox Street in Mayfair.
And you were in Mayfair.
Growing.
And now you're in Marylebone. Well,
That's
listen.
right, so
Hey, Yann,
good
thank
evening,
you.
everyone.
Yeah, thank you for coming and doing this. I know everybody's excited to see what's going on with Blend and find out your views on some of the things that are going on in our peer-to-peer lending community and our investment sector. Obviously, we've had some ups and downs within the last, I think we spoke in October of 2020, so we're a few months down the road. And so what we've seen with the UK, COVID has started to stabilize. We've had this lockdown now. How has the operations at Blend changed since the last time that I spoke to you in October? Is everybody back in the office? Are you working remotely? What's going on with that?
So not yet. We're coming back progressively in the office. We're probably 60% now back in the office. We have obviously now some COVID policy in place where we're testing everyone twice a week. So yeah, but it's good to be back. Generally, I always tell the guys I'm not a big fan of working from home because I kind of enjoy coming to the office when you have a great team and it's very friendly. I enjoy being in the office, talking to everyone, and as well to generate ideas. It's great. You need to bounce with everyone to really generate ideas. So it's good to be back in the office. I mean, I think I expect a couple of months everyone will be back. So it's literally London is reopening properly now.
So are you the one are you actually doing the COVID testing yourself? You're the one with the Q-tips up the nose? You're doing that?
We have to do it ourselves, yeah. So we have in the meeting room all the boxes, and we use the meeting room. Everyone in the morning when they come, they have to pass the test before they get in the open floor.
Hey, that's very responsible. I can imagine Roxanne over there with the Q-tip going up the nose.
In the mouth first, and then in the nose.
Okay. I've never actually had a COVID test, so I heard it's not very pleasant. So it's not the best. Let's talk about, so what's going on at Blend? What is your loan book size right now at the moment?
So with land now, we are about, on Monday, I think we'll be above 30 million pounds of land, and about 50% of that has already repaid. So 15 million.
15 million repaid, so about 50%. And have you found that, one of the things that I hear over and over from people about Blend is that your loan supply is not the best. Some people find that you got money sitting around, and I know personally from talking to you in the past, this is about because you're very picky when it comes to what you loan money on. You don't want to be lending to garbage loans. And so what's going on as far as the loan supply?
Our supply has grown. Literally just last year has doubled, and this year we expect to over double. We're on track to over double. So the supply is growing. The problem is the lending side is exploding. That's in a way better problem than the other way probably. But yeah, we had a good track record. We've demonstrated even with the black swan and literally a crazy world, we've managed to have very strong track record. So literally the demand has really exploded from the lenders. So when you have like, hundreds capacity of 100 on the borrowing side and 500 on the lending side, for sure some lenders miss it, and that's a bit being victim of your own success. We're growing the supply. We're actually investing a lot to grow the supply. Since the beginning of the year, literally, we had 3 new hires. 2 were on the origination side to bring more deals. One is a very senior person, like a COO, who used to work as a solicitor at Allen & Overy and then in the private equity. So the team is growing to have a strong structure and more origination. But it's true, like we're rejecting 98% of the loan requests. So the supply is tight, and we see a lot more than what we offer on the platform. But you got to do the right thing as taking only the deals we like. And that's why people want to lend with Blend, and that's why the lending side is exploding, I think. We're not even spending pretty much anything on the marketing side for lender acquisition, because people just come and heard about Blend and follow the track record and keep coming.
So you're saying that you have a lot more money that wants to be implemented into loans than you have loan supply, because you're being very picky as always. You're denying 98% of the loan applications that come through, which I think is a good thing. That's a testament to what you do over at Blend. And what I always thought about Blend is that you've got this very high standard. You're like the guy that will only date the woman that's a 9.5 out of 10 and higher. So he doesn't get a lot of dates, but when he does, they're good dates,
Yeah, but I'll let you do the comparison. That's
it's the booth.
That's what happened. So everyone really who's really wanted to lend has been able to lend, but there's some period where it's true that you have to wait before you can get involved. So there's a bit of a queue. Not always, but there's a bit of a queue, and when you're done on the queue, you've registered very recently. Sometimes you have to wait a bit to be able to start getting onto the loans. But as we said, it's a marketplace, so you need to manage supply and demand. And in this business, having strong demand from the lenders, because we have good track record, is literally the way to do it. It's tough to be 100% exactly balanced.
Mm-hmm. Yeah, absolutely. So you've had a bit of time for the loan book to sort of run through this COVID bump in the road, and how are you finding that borrowers have been able to navigate that? Have you had any situations with your borrowers where you've had to sort of restructure things or give them some leniency, or have they generally been okay on the repayment side?
So the deals, the performance of the book has been very good. To date, we have no loans that are being late. So 100% of the book is performing, which we're quite proud to say. Yes, for sure. There was a bit of a challenge. Like literally last year, probably at the worst time was like around April and May. We were talking to our borrowers a lot more, trying to help them out, especially on the finance side, to make sure things were progressing and if we could provide them help. And that's very important. That's why we think more as a partner than being like, the traditional lenders like historically banks were, and don't have an adversarial relationship, but like more a partnership with the borrower. So we've been trying to help them. We had a case, for example, where probably because it's delayed, due to COVID, the loan could have been delayed. We found the borrower was overrunning his cost. We found him a second charge to bring extra capital on the loan, which is a key thing. We didn't make any money bringing that. We just introduced an introducer off platform. Wasn't Blend doing it, but we helped them doing it, because by bringing this extra source of capital, the borrower was able to complete the project and repay the borrower on time, and everything worked out well. The second charge lender was happy because he charged a lot more than we did. Our lenders were happy because problem was solved and everything got repaid on time. Literally, there was no stress. We'd never been offside, and the board was happy because he still made his profit, probably less than initially, but in Corona, that was great. Second thing we do, I don't know if you've seen our loans, but very often we, on a loan where we believe, for example, the developer is going to need 12 months to develop, to build the properties, and then 6 months for a sales period. Typical lender will offer 18 months. We offer them 24 months. For the first 18 months are rolled up interest, and the last 6 months are interest only. So those 6 months of interest only are like a bit of an extension in case they're late, but we ask them to service the interest, so our loan to value doesn't go up. We protect the lenders that way, not to expose them to more risk in case developer is late. And we had few cases where the developers needed to use those extra 6 months, which the lenders didn't mind because initially they committed to lend for 24 months. If they got repaid at month 21, well, they got the interest service on the last 3 months, and then at the end, they got paid the full capital and 18 months of roll-up interest. So we structure in a way that allows the developer to have a little bit of volatility, if that makes sense. And last year, that was super helpful because that extra time allows them to complete the project. And that's a much better outcome than having a default and then taking position and selling the developer in the middle. So as long as the developers are progressing and they are literally late for a good reason because getting materials was potentially difficult last year, we're okay to we package it, we structure our loans in a way that works better for the lenders and the developers.
Yeah, and I've noticed the building material costs have just really gone up a lot. I've got some friends that build in the UK and the US, and especially in the US, they've been saying that the building costs really rocketed up. So
yeah,
I don't know if that's a problem for the bars.
I mean, for sure, it reduced their profit a bit, but there's enough profit to absorb for that. I think it's been for two reasons. First, you have currency. The pound's been relatively weak historically. I mean, in the last 4 years maybe. So that's not great for UK developers. And then from now, I think commodity prices could go higher as well. In my view, it's possible. The global demand is very strong, so that's a challenge for the developers. But every project we look at, they still have their at least 20% profit into that development. So they're doing okay.
The thing, Yann, the thing I like about you is your background before you got into the peer-to-peer lending side was always sort of risk management because you were an options trader. And I have a bit of a gambling side to me, even though you say, well, options is not really about gambling, it's about managing risk too. So that's what I appreciate about you, and I've always found you're quite astute when it comes to risk because you just don't want to take that. And that's really what the peer-to-peer lending sector needs right now, is people that really do understand risk, because we've gotten burned so many times over and over again by bad loans also, and bad people that have been running these companies. And we see news story after news story. There was one that came out just this week, and we'll talk about that a little bit later. So Blend has always been sort of a high payer of interest, within the peer-to-peer sector. You're kind of on that top end, and a lot of the times we talk about high interest includes, probably some higher amount of risk. You paid, I looked on the website, statistically an average 10.10% per year to lenders, which is very healthy. Do you think that these investor return rates are going to remain steady at that amount, or do you see them fluctuating down or up?
Honestly, I think they will come off. I mean, I think they're already down. The 10.10% return you're talking about is since we started the business. More recently, they're more between 8 and 10%. So the average is more around 9 if you look at our last 12 months rather than since the beginning. And there's two reasons for that. One, initially when we started, we did a lot of loans in Northern Ireland, which was to me a very good opportunity, and it's proved to be right because we've done a lot of deals there with 12% return to the investors, and we've done incredible deals there that have all repaid now. So the returns were higher. And two, let's be honest, and you talk about Blend as an example, but there's plenty of cash out there on the platform and everywhere. People have a lot of cash right now. So lending is competitive. You have two ways. If you want to if you want good quality deals, either you put your rates down or you keep your rates too high, and then you end up having higher risk loans because there's a lot of cash for lending. So I'm not saying it's crashing and we're going to give loans at 6% to the investors, but I don't think the interest rate average this year will be 10%. I think we're more targeting around 9%.
Mm-hmm.
And I really prefer to have a 9% loan with a similar type of risk we did in the past, or even a bit better, than increasing the risk and keeping returns above 10%. I think we could do that. If you were in lending 5 years ago, you could get 12%. When we were giving 10% on the platform, you could get 12% at the similar risk. But the rates are compressing a little bit because there's a lot of cash out there.
Right.
But the risk reward, sorry, I was just going to say that I think the risk reward is still very attractive. If you look that we had 10.1% return since the beginning and we haven't lost any penny. And the more important is sometimes people say they haven't lost anything, but you don't know what's cooking in the current book. I mean, literally all our loans at the moment are literally performing and nothing is late. We had couples loan late during COVID. Now they've repaid. I mean, it shows that we have a very strong track record, basically.
Yeah, and you've been. When did you write your first loan on the platform? When was that?
We did one in summer 2017, which was a bit more like testing the platform.
Mm-hmm.
At the time, it took us 4 weeks to raise £250,000.
Mm-hmm.
To give you an idea. And last loan we've done of 1.7 million, it took 6 minutes.
Yeah, wow. So yeah, if you want,
the platform has grown. Yeah.
If you want to get onto Blend, you got to have fast fingers. By the way, if you can do me a favor and hit that thumbs up button, we got about 50 people watching right now live. If you can hit that thumbs up button, subscribe to the channel too, hit that notification bell. It helps the channel out a lot. And Yann has generously given his time here. I really enjoy talking to you about all of this stuff because I want to get the ins and outs of especially what you went through now with your FCA authorization, which I know you've been working on for a while, and you finally got that green light from the FCA saying you are authorized. Now, there are some people who are on the other side saying, the FCA, it doesn't really hold much weight anymore because they've had so many disasters with some of these companies that they've authorized have just been, not good companies. So does the FCA authorization hold a lot of weight? But I always say it's better to have it than not. If nothing else, you went through, you got your authorization. How long did it take for Blend to get authorized? What was that process like for you?
It was long. To be honest, it took us a long time. I think timing on our journey was a bit a change because when we started Blend, I was saying you in 2017. So we really did the business plan in 2016. That was a time where everyone was in interim and went through and got the direct regulation. So the queue in 2017 was very long, and we had the platform, we had business, we had lenders, we had boards. We wanted to do business, so we went through the route of appointed representative, which worked pretty well for us, to be honest. I think good thing we've done is we've worked with a compliance company rather than another platform offering an AR without being a strong background. So that worked pretty well. But at some point, you want to be directly regulated just as an operational risk as well. You don't want to rely on someone else to operate your business. So we wanted to have the direct regulation. It took a long time. It sounds, just from what I heard, I don't know, I cannot compare really because I don't know the process for the others, but clearly everyone's got regulated. The law platform got regulated in 17, and then we all know the stories. So clearly the FTA had to get a lot stricter to onboard new companies. And don't think I was talking just before we were chatting with Lawrence, with you, I don't think there's any platform who got it in the last 12 months or even the last 18 months. I'm not sure who got it. So it shows you that the door is not widely open to everyone to get the FCA, which in a way is a good thing for a business. It basically increase the barriers to enter the markets right now. And honestly, the thing they've been asking, I don't know what's confidential or not, but they've been really digging on everything, which is the right thing to do. I mean, it's difficult, it's a bit painful to be under that scrutiny, but it's a good thing. And I'm sure they have improved as well a lot. The FCA has improved a lot compared to when peer-to-peer initially started. Basically, I'm sure the FCA has learned a lot as well, probably learned from some mistakes as well with the platform that went bust. But yeah, in a way, it's still a good thing that there's an FCA regulating this market. You still have countries where peer-to-peer is not regulated.
Yeah. What kind of scrutiny do they put you through exactly when are they looking at all your financial numbers? Are they checking your bank accounts? What do they do?
Everything, honestly, everything. Policies, loan, what transparency we're showing on the information pack, how we're doing our projections, our wind down scenario, all the policies, conflict, literally everything. That's why the process is so long. Everything, but yeah, it's a good thing. I mean, it's a good thing, and I'm sure they'll come and knock at the door in the next 6 to 12 months to come and check we're still doing things right. And that's why I was saying we hired as well a CEO who started a couple of weeks ago now, which is going to help us as we're growing, keep the structure very strong and the governance very strong, which is very important. But yeah, it's a good thing to have it, because honestly, people who are getting it now I've seen what we went through. I know that the requirements they have today are higher level, and I believe higher level than they used to be.
Yeah, absolutely.
Which is logic.
That does make sense. As they learn from their mistakes in the past, they'll tighten down the scrutiny and make sure that everybody is on the up and up as best they can. Yeah, and again, if you have questions for Yann, put them in the chat. We'll do a little Q&A at the end. So hang out till the end of the stream. We'll try to keep it under an hour. Like we did last week, we actually made it under that. I think that was the first time in the couple of years that I've been doing this we actually went under an hour, so that was a good thing. Okay, so one of the questions that I've been asked is, with your auto lend, I think the minimum is how much on the auto lend?
£1,000.
Okay, so one of the questions that we had was, why... Is there any plans for that to be decreased at all, just because of the cash drag that some people are seeing from the auto lend being so high? Would you consider putting it a little bit lower to get that money deployed in some ways?
So there's one thing we're considering right now, which we're going to go ahead on this, is putting a cap maybe on the auto lend to allow more people to participate in the loan. The loan minimum, we don't have any... I mean, that's a question, an issue we have not every board meeting, but almost. Like, it's always a challenge. Like, where's the correct minimum? Is it higher? Is it lower? We always end up paying at £1,000. The challenge you have if you go too low is great, because you open the door to some people who wants to participate, and we are very into the democratization of investing. But you open the door at the same time. Every time you go lower, you open the door to more people who are less sophisticated, and you take higher risk of having people investing who don't understand the risk. Now, the good thing is you have an appropriate test when you register, which would filter most of the people who don't understand the risk. But still, the risk is obviously higher and higher as you lower your minimum. So we don't have any plan for now to lower the minimum. What we wanted to do is cap the maximum. But end of the day, really, when you have, let's say, as I say, 100 loans and the equivalent of 500 from lenders to invest, or even we're not 5-to-1 now, but let's say we're 2-to-1 or 3-to-1, you're gonna have some people missing. And if it's not people missing, that means you're giving 10% to everyone, rather than you cannot create more loans than they are on the platform. So what we're working hard is really increase the origination, and that's our big focus for this year, is increase the origination with the same type of quality of the deals and due diligence we're doing. And that will be the key thing. That would be the key thing
I've always,
for us
and too, I've always wondered about those questions because when I've gone through the questionnaires for this FCA regulation on the platform, some of them are very different to others. And I always wonder, does that really filter out the people that don't understand what they're getting into? I had one guy who emailed me and said he just kind of took a guess at the A, B, and C's and got it right and passed right through. Not on Blend, I'm saying it was on a different
Yeah, I would
company.
say if you manage on Blend to get it randomly, honestly, go and play the lottery. Because I think it's quite the opposite. Our test now, because we've been as well to the FCA, so we had the test since we started the business,
Yeah.
which wasn't in the regulation wasn't in place, but we changed it when the regulation came in place. We make it stronger, and it is. I mean, the good thing is you can take it multiple times, but honestly, it is not the easiest test out there.
No, I
But
found
it's
your
a good
one was
thing.
a
It's a
little
good thing.
difficult, a little more difficult than the other. I think I had
Yeah,
actually, I don't know if I did it maybe two times. I think I might have failed the first time, Jan. It's
it's
quite,
possible.
quite embarrassing to admit, but I don't think I was paying attention at the time. So that's kind of something that you tend to just keep an eye on. As far as the minimums go, I think you want to keep a certain level of investor as far as their knowledge of what they're getting into. Because if you're letting things in at a £10 investment, you're going to get that sort of lower tier investor maybe doesn't quite know what they're getting into. So I mean that makes sense.
I think there's a risk. I mean, it's always a debate because there's pros and cons of lowering and hiring the minimum. So we still find that the sweet spot is £1,000, but obviously some people think different. I'm sure.
Yeah, I got to get my options trades more profitable so I can get some more money. I was just telling Jan before the stream started that I had a dabble on an options trade a few days ago. So we've been doing this series on Financial Things YouTube channel where I took an amount of money and I put it on Trading 212 to try to beat the indexes. And one of the companies that I did very well with was a company called Magnite, which is a US tech company. I sold all the Magnite shares and I decided to have a punt at an option this past week, which did not go very well. In full transparency, I think it was probably a bad decision at the end of it. But since Jan has that experience with options trading, we had a little bit of a talk about that. But that again is for a different stream, very complicated.
For another day.
Yeah, so let's talk about your impressively low default rates, which I believe you've only had one project total, as long as is that correct? One total that's
Yeah.
gone into arrears. So how have you been able to keep those projects, and these loans on task to where all the other peer-to-peer lenders have really struggled with this side, but Blend's managed to keep those defaults at the very bare minimum. How are you able to do that?
Yeah, sure. I mean, to be, as you said, completely transparent, we only had one loan that was basically defaulted last year due to COVID, and we managed to basically recover full capital, interest, and even penalty rate on that loan. The property was sold during COVID. The site was sold during COVID at above the valuation report we have, which is very important. So when you say how do we manage to get good track record, I think it's important. It's all about the team. I mean, we have a very strong property team in-house, including a property developer in-house who we work with, and we do like literally a very strong like due diligence on every deal, and that's a key thing. I know people look a lot at the loan to value, and that's very important. I'm not going to argue with that, but a 65 or 70% loan to value from project A to project B could mean totally different risk. And I think it's very important before you vet the deals is to vet the platforms and their experience. So we have very strong property experience in-house. Another thing important, I would say, the quantity QS company we use and the risk valuer we use, we vet them as well. We don't just use any valuation from anyone, because you would see some valuation reports giving you too high valuation sometimes. So the independent consultant we use on the valuation, solicitors and QS, we as well make sure we use the right ones. And so I say having a very strong property team is very important, but also having a finance team is very important. Property guys, I say in general, when you talk to a developer, they always look at the best case scenario. And finance guys always look at the worst case scenario. And that's how we think finance background is very important, because the property team will kind of highlight the risk on the project. And then you have the finance team who's doing the risk analysis and can determine how to structure a deal, where to price it, and is the deal good or not good, and what's the risk reward end of the day. And that's a very important point. So we have a team of property guys who are literally doing all the due diligence, and then it gets into the credit committee, where you have Charles, our chairman of the credit committee. He has spent 35 years at Lloyds Bank reviewing SME deals and property deals, and myself as well, where if we're not comfortable with the risk reward, we don't think it's a good deal enough. So the team of who's under the platform is very, very important. Like any investment you do, really, if you buy equity direct on the stock market, then it's all your own decision. But if you're going to invest your pension with Fidelity or whatever companies, you look who's behind, who's managing your money, and who's doing your due diligence before listing on the platform is extremely important in my view. And that's what we've built. We're very proud of the team because they've done an amazing job vetting the deals, and that's how we managed to build a strong track record, I think.
So, let me ask you. You know what? Let's take a couple of questions here. We've got a few questions from people that are watching. Again, this is Yann Marciano, CEO of Blend Network, which is a company we talk quite often about. Let's see here. What do we got? Looking for some interesting questions to make you sweat a little bit. Gail Leach says, "Is it the UK is thinking about banning? Well, I'm presuming the FCA is thinking about banning advertising of peer-to-peer lending companies. How are you going to handle that, and what will that mean to you if that actually ends up going through?"
I mean, it's not like we're going to have the choice. If they ban the marketing, they ban the marketing. Yeah. So we'll comply with anything they say. I think, as we're saying about the minimum investment, where we think £1,000 is great, because even if not everyone has access to our deals because of the £1,000 minimum, there's a big democratization of those deals. Historically, to invest on one development or bridging deals, you would need £250,000 in one deal. Today, with the technology, we syndicate the loans and we give access to this product, which I believe, in my view, has a great risk reward, to a lot more people. Obviously, I have to say capital is at risk, but the risk reward, in my view, is great. So it's a great thing. If the FCA is going to the route where we can't accept retail money anymore, then I'll be super disappointed, and hopefully we're not going that route. But they could decide to say we're banning retail investors to invest on those products, and that's not going to be basically it's out of our control. But I hope rather than banning peer-to-peer market, they'll ban the platforms who are not doing a good job. Maybe take some license away, or don't grant the license to the right guys. I'm not saying there's no risk. There's always going to be a risk, but if you invest with professional company who's doing the proper due diligence and has the proper setup in place to issue those loans, then it's great. I mean, we don't see ourselves as, I know obviously because peer-to-peer, I understand it, but don't see ourselves as peer-to-peer. See ourselves as professional lenders to property developers. The peer-to-peer is a technology we use to syndicate those loans and to allow people to access with £1,000. So to me, peer-to-peer is the tool for people to access those deals.
Mm-hmm.
Our job is lending, and to lend is about understanding the risk of the project and picking the right project and basically looking at the risk reward on each project. You see, I mean, that's how I see the business we're building. We build a technology, which is a great technology, but that's to give access. That's a different thing.
So Gail's question was more about the advertising of peer-to-peer products. So maybe they don't necessarily ban peer-to-peer lending in its whole, but they say, well, you can't advertise this product anymore. How do you bring in new customers at that point?
Honestly, if you cannot advertise, if you gotta stay and hide, you can't. It becomes very difficult. I mean, to me, it's another way to say we don't want to have retail on this on the platform.
Mm-hmm.
If you cannot market, if I cannot tell people we are doing this, how are they gonna come to Blend?
Right. Yeah. Well, hopefully it's something. Do you think it's going to happen? Do you think that that's something that's going to happen or not?
I hope not, honestly. No, I mean, it's tough to say, but I don't think so. I mean, I think it's under review. Doesn't mean it's done yet, but there's a lot of platforms who are doing really well out there, and it's what we're building is great for the economy as well. I mean, we know the country needs to build, 300,000 new houses per year, and the institutions have no interest, to lend less than 20 million pounds.
Mm-hmm.
So if you kill this platform, which I think can be a very good help, I think it would be a big mistake. As I said, ban the bad platform. Don't ban everyone because some of them are bad. There's better way to do it. And to me, banning the marketing is in a way banning the retail investors to access the platform, right?
Yeah. So it would sound if they do that, then retail peer-to-peer would just be over.
And then you got to go back and reshape to do just high net worth and sophisticated and institutional money. So that's what they gave us no choice. That's what we're going to do, but I don't think it would be great.
Yeah. Okay, David Lightly says a 9% average rate seems good, but to understand the true level of risk, it's helpful to know how much the borrower is paying interest-wise. Do you disclose that now about how much borrowers are paying in interest?
Deal per deal, you can see how many fees we got and how many, what's the borrower is paying per, what's the spread exactly on deal per. It's usually 2% spread. So if you receive 9, the borrower is paying 11% interest rate plus fees, and everything is disclosed.
Okay. I always wonder too. So since you have kind of this, I would say in the grand scheme of lending a smaller loan book, you're a growing company, you've got this balance of trying to write enough loans to keep the business financially viable, and then you've got the side of, well, you don't want to write bad loans. Is that sometimes a difficult thing to really, maybe even on the moral side of things, to say, well, I'm not really sure about this loan, but we need to keep fee generating. I think that was something that some of the other companies that went under ended up doing. They just wrote a bunch of bad loans because they like money. They want to keep generating fees. Since you're only accepting 98%, sorry,
rejecting.
If you're accepting that, if you're rejecting 98% of all the loans that are coming across your desk, does that ever become a concern? You're like, damn, we're just not getting enough loans that are good to make the company profitable.
I mean, for sure, you always want to do more. At the moment, we're not really, the profits, we're not looking to reach it this year or next because we want to invest, and we've done an equity round, we have enough cash to invest. So that's what we're doing. We're investing to grow quicker than just organically and grow slowly. But you're right. As a platform, there is a risk. People say, I want to do that loan because I'll make money on it. So there's two things we have. Personally, I have invested on every loans we've done to date. So that shows to people as well, I believe in what we've done.
So you said personally as in yourself, or not the company in general? Just
not the company. We don't risk the company's money. But as a person, because I believe in it, and that shows really skin in the game, I think. But the second big thing is the chairman of the credit committee. He is not a shareholder, and he's getting paid the same thing if it's yes or no. And if he says no, so he's independent basically. He's an independent person, and if he says no, we don't do the deal. So that's how you mitigate that risk, is by having this independent arm to say no. But I tell you, the problem is people who are greedy and say, we want to do deals to go quicker, and they say yes, yes, yes. It doesn't work in the end. I don't believe in that, because we've seen it too many times, right? All those platforms who actually went bad, I don't think it was because they didn't write enough loans. It was always because they wrote too many loans, and they were bad loans and they went bust. So it's not a question of not growing quickly enough. It's about they wanted to grow very quickly. And that doesn't sound like that's what you're blaming me about today.
No, definitely not.
So
you have the opposite problem.
So yeah, and that shows because we are very conservative, and that's the approach you need to have. As I said, we're acting as a lender, not a platform.
Yeah, absolutely.
You gotta lend money like every day, like it's your own money, and that's the culture, really.
Right. Yeah. Use it like it's your own. Philip Walters said, what attracts borrowers to Blend given the other options available in the marketplace? I mean, I think we've already discussed this. You guys have a very conservative risk in what you're willing to put loans on the platform to keep the quality of loans high. Any other things that you can say, well, this is really what sets us apart, aside the credit risk?
You're saying, how do you attract borrowers? It was the question you said?
Yeah, I'm sorry, I thought you said lenders. Yeah. What attracts borrowers to Blend given there are other options in the marketplace? How do you compete for the loans?
Yeah, so in terms of pricing, we are not more expensive or cheaper. We're in the right price compared to the market, and we know we always do market analysis to investigate the market and where our competitors. The competitors are not really peer-to-peer platforms, to be honest. They're more like, in general, other alternative lenders. So you have two types of potential lenders. It's either the challenger banks, which are cheaper than us, but they go lower on the loan to value, or the alternative lenders. And we are in the right price. What we're trying to do is bring them a very good service and build a strong reputation and a good name for people to use us and reuse us. So I don't think you can ever have 80% of the market for yourself, because you never have a monopoly in finance. There's always been loads of banks. There's never been like one bank ever. But yeah, I think what was strong is really on the service and the trust. They know when they come to Blend, and as you said before, things getting funded quickly, so they have confidence. We're going to provide them the funding, which is a very important thing for a borrower. And even when you had last year COVID and lockdown properly in May, we were lending. We stopped lending just in April, because if builders were not on site, there was no point giving money away. But in May, when the builders could go back on site, we were able to lend. And that's thanks to our diverse source of funding. And that's a big thing for a borrower.
Yeah, absolutely. Wayne Bernard has asked, what is the upper limit you can currently invest into a loan? So is there a maximum somebody can put in?
Technically, it's first come, first served. So there's no maximum. But if you're going to have big lenders, they're going to be like institutional lenders or family office, and they speak to us. Okay. Because before coming on the platform, they actually spend 6 months auditing us, reviewing our governance and policies and everything before they come. So we have a relationship with those guys, and depending on the loan size, we might tell them, please don't put more on that. We never had an issue where they listen. If that was the case, then probably put more a strict rule for them.
Okay. John Day asks, is the secondary market seeing much activity at present? There's nothing on there. Have you had much activity on the secondary market, or people?
We actually had a lot more activity in the last 2 months, but there's never something available, because I was surprised myself. If you list something on the secondary market, it's not marketed anywhere. You got to go on the platform and go on the secondary market page. When you list, you decide to sell, nobody can take it for the first 24 hours, because we want to give everyone the opportunity to look at it and review the information rather than take it in 3 seconds. Every time something is listed, it's gone in seconds. We had one the other day at 1 p.m., 11 p.m.,
Mm.
someone logged in the platform and bought it in a second, and the second it was open for investment. So there's not many sellers usually because people are keen to hold their position, but there's a lot of buyers. So that end up being not many loans on the secondary market either, because those guys who are watching the secondary market all the time are buying stuff every time a loan is out.
No, that's
Available.
interesting that you don't allow sales for 24 hours. I think that's a really good thing, but it could be difficult for people to buy, so they've got to be hitting that fast finger.
Yeah,
To
they see
grab
the
it.
opening, they see at what time it's opening, and they have to be in front of their computer 24 hours later when the other person has offered a loan part. But for the seller, it's been great because they've been accessing liquidity very easily. I mean, had people been investing on an 18-month loans for 6 months and able to get out,
Yeah,
literally
yeah.
get their money back 24 hours after they decided to get their money back. I mean, it's great.
Yeah. Alan Stratford has asked, why, according to your blend stat page, has the expected default rate gone from 1% to 3% for 2021?
Nothing has changed. It's just we still hope we're gonna outperform that. Is as the loan book is growing, you can make expectation that default could be more, but there's nothing literally behind that we think a loan is gonna go into default or something like that. It's just I think it's reasonable to take 3% assumption for a loan book that is gonna be 3 times bigger than it was, like a bit more than 12 months before. So I think it's just a reasonable assumption. I still hope we're gonna outperform that. But that's it really. There's not much massive. I think it's more realistic than anything else.
Okay, Tony said, do you offer an IFISA? And if not, why?
We do not offer ISA basically. We would definitely consider it. I'll be, again, you say I'm too transparent, but I'll be transparent. The ISA for us is a lot more time to manage. It's a bit more complex to manage, which is doable, but we're quite busy, and because there's so much lenders at the moment on the platform, if we open an ISA right now, then we're going to increase the lenders a lot again. So we will do it at the right time, but could be later this year or beginning of next year. I don't know. I'm sure it won't be in too longer after that, but it doesn't feel like it's the right time to really push people to invest a lot more. We have some ideas as well for some products that could fit the ISA as well. There's also some bit negative press around ISA being able to invest on peer-to-peer. I don't know if you heard, but we're also looking at that closely and see how it evolves, because if they want to buy retail, but they're clearly not going to allow ISA on the platform. So we're looking at it. We say, see how it goes with the others, and then we'll do it if it's clearly approved.
Yeah, understood. Let's see. Dave Dawson said a loan book of £15 million seems relatively small. What kind of size loan book do you need to have to break even as a company? Is there that magic target number for a loan book, or is it just a?
It really depends. I mean, we could be easily at £25 million with the break even easily, but it depends at the speed we want to scale. So the quicker we want to scale, the more investment it needs. That means the further down the line you are getting improve. It's like, I mean, I don't want to compare ourselves to Uber because it's a different world and they're scaling like crazy, but it's like asking them where is their break-even point, and they tell you they have to generate billions and billions before being break-even. Doesn't make sense, but that's because they're scaling. So this is a very strategic discussion we have at every board meeting, and we're reviewing all the time, and even if I knew I had an idea, it's not really. I'm not that transparent.
Yeah, but you're well capitalized because you said
we're very well capitalized, and that's why I mean that's why we're comfortable. That's not obviously that's not at all a stress, and there's no stress at all around that. I mean,
Okay.
You can see, I'm sure the accounts on Company House.
Yeah. John Day said, "Are manual laborers, not laborers, are manual lenders able to invest at the moment, or are the auto parts filling up all the loans? How does that work as far as the auto? How does that get deployed at a certain rate, or
So
is there a priority
the
system?"
platform, to treat customer fairly, we have one simple rule that is the same for everyone: is first come, first served. So technically, if you are on auto lend, you've have agreed to commit to the loan that is coming now before, right? Maybe you've committed a week ago. So then the auto lend investors are first. If you committed on auto lend 2 years ago, then technically you are first than the person who's switched on auto lend yesterday.
Okay.
What we tend to see is on every new loan that is being listed, people on auto lend don't have unlimited amount of cash. So every time you have people on the top list of the auto lends getting the auto lend switch off because they are out of cash. So then people on the auto lend goes up. Now when we have small loans, it's purely auto lenders that manage to get involved into the loan. But as we're getting bigger loans, then manual lenders can get involved. And that's one thing as well on the strategy that we're doing. We're doing bigger and bigger projects. So our next project to be listed is potentially going to be £3.5 million. So we don't want to grow massively quickly one shot, because otherwise you have too much concentration risk into one project. But we're gradually growing the size of the project.
Right. Okay. That makes sense. Dave says, would Yann consider doing a pledge type of system where manual investors could pledge before the loan comes out?
Potentially when we do bigger deals. So if he refers to underwriting deals, I mean, today we don't need, because the liquidity from the lenders is very big compared to the project, so that we don't need. But the pledge could be interesting if you want. I think some launch platform have that historically is bad, saying let's try to get a piece underwritten before it's on the platform. It's a great way to start doing bigger and bigger loans. As I said, we haven't done it so far, and we don't think we need, but that's something we could consider in the future.
Okay. And do you have any promotion, if somebody's a new investor, do you have any like promotional deals for people wanting to sign up at the moment?
So what we have is we have referrals. So if you know someone who's a lender on the platform, they can refer you, and they both get a kick, basically. The new lender could get 1% bonus on his first investment, cashback.
Okay, so you're not doing anything strictly for new investors who are coming into the platform. Presumably you have more demand than supply, so you're not really needing to do anything at the moment.
That's right, yeah, and then the rates are attractive as well, so it's not like people always want more. It's always great to have more, but it's not like we're passing, we're doing a deal at 11% and we're passing 6% as well. We're taking a fair spread, which we believe is fair for having money to run the business, and at the same time giving most of the money. And that was one big issue, I think, with peer-to-peer in the beginning, is you had people doing loans maybe above 15% and passing to the investor 8%. And then the problem is, you would think the interest rate should be basically a reflection of the risk.
Right.
But it's not. It hasn't always been in peer-to-peer, and that's why I think it's important to show what the borrower is paying, because it's the all-in rate that really reflects the risk, rather than the lender rate. Because the lender's rate is 8 on the platform, who's charging 5% spread, and it's 8 on another platform who's charging 2% spread. It tells you about the risk pricing difference. But we've built internally as well some pricing model where like the price to the borrower is determined according to our discretionary model, and same thing on the lending side. So every time we issue a loan, it's not like we say, okay, that's the price, and we give that price to the borrower because he's a good guy, or that price because X or Y reason. We have like a proper matrix where we have full of inputs, where we put different type of inputs, and depending on how we price the categorization of the risk, we give a price.
Okay, yeah, I understood. One of our viewers has asked if we could just run through the statistics page, so I put that up on the screen here. See, you've written 71 loans, capital repaid 48.14%, 51.86% are performing. So if you actually add those two numbers together, it comes to 100%. That's good. I do know that my math in that respect. So looking at your actual and expected default rates and arrears, pretty self-explanatory. You had that 1 year in 2018 with the default of 4.5%. That wasn't a bad deal then for you. Yeah, but you got the lender's capital and interest back, so that's a good thing. I mean, you honestly, your stats page is kind of a little bit boring compared to other peer-to-peer lenders because you've got a very clean sheet. Yeah. Yeah, I mean, that's really it. We've got the average return per annum since you started at 10.1% and funded so far 25.677 million. So that's really it for the statistics page. Not too much to show up there, but somebody had asked if we could run through that.
Sure.
One other question we have. We're going to probably wrap up soon here, almost an hour. David Lightly says, I think we spoke about this. Do Blend have property experts in-house, and do they do their own legals?
Property expert for sure. I said we had someone from Octopus, GLL, RBS, like real estate, property developer. So we have lots of people with property experience. Solicitors, no, we used independent solicitors. I think it's better for two things. I mean, first, cost of the business. You can have more when you need more and have less when you need less. And second thing, for example, if we don't register the charge in-house, what happened? Whereas if it's a solicitor, you have their PI to make sure. So it gives a bit more, I think it's a bit more secure to use those independent guys.
Okay.
And we use proper firm that are very, very good, and we've tested them.
Dave Dawson says, if you could put some form of a guide to upcoming loans, it would help, as we could put money in knowing there's a chance of it being used and utilized in the short term. So is that something you would consider doing, like maybe listing future loans that are upcoming?
Yeah, I mean, what is challenging, especially now, is we have a pipeline for sure, but it happens that a deal in the middle of the due diligence fall through and we don't do it anymore. So we tend to put the deals last second on the platform. It gets funded quickly, and then we give to the borrower the money immediately. If we put it on the platform and we say we give you the money to the borrower 2 weeks later because we plan it to list it that date, you start losing service, and then you start losing some good deals for the lenders. So that's a bit of a challenge. I'm not saying it's not impossible, but it's very difficult to have it really written in stone. Like things change, especially during lockdown, because lockdown, like we have a very strong pipeline now, but what we've seen during lockdown is deals were definitely slower to complete than pre-lockdown.
How much time in advance do you know that the loan's going to come out on the platform? Is that literally like a 1 or 2 day period, or do you have a few days advance notice?
It depends. It really depends, because we're waiting most of the time. What happens is you're waiting for 3 documents. They could happen in 24 hours. So the solicitor, the counsel, or the borrower can take 3 weeks to give it to you.
Okay.
And they keep telling you tomorrow. You see what I mean? So it's and depending, if he needs to complete tomorrow, he's gonna get it done. But if he hasn't exchanged yet and he's busy on another project, it could take 2-3 weeks.
Right.
The market, that's the nature of the market. Even us, like, we have a very good idea of how much we're going to do over the next 6 months. But next month it could be those 3 loans, and then the other 3 loans next month. So the 6 could happen next week. It's there's a bit of volatility around that.
Yeah, and you don't want to be putting up loans that are getting yanked off of the pipeline, and then because that creates a bit of a bad
And
taste.
we've never done that, but
Yeah.
I find it a bit frustrating. I'm sure I understand sometimes what once in a while it can happen, but taking the money from people and then refunding them is not great, right?
Yeah.
You collect the money from everyone and then you tell them 2 weeks later we're refunding you. It's not great. We've never done it. I'm not saying it's impossible that one day it happened,
Mm-hmm.
but we're trying to avoid it. And to
Yeah.
avoid it is about listing once we have everything in line, or missing one document that's we'll give the money to the borrower subject to this document to receive it. But there's nothing commercial. There's very strong positions. We don't do it too early because we know we can afford to do it last minute because the funding will be quick.
I understand. Totally understand the reasoning. Again, this is a question that I've wanted to ask you myself, and of course, this is completely an opinion-based thing and not financial advice. But if peer-to-peer lending, and Robert paid to ask this, if peer-to-peer lending wasn't available to invest in, or let's say you have all your money that you're comfortable with inside of the peer-to-peer lending sector, where would you invest money at this point in the way things are, in the stock market being so frothy right now? You're not getting any money in the bank. Bonds are terrible at the moment. Where would Yann look to get some investment money deployed? Would it be in? Would you have a punt at some Bitcoin?
No.
No,
I mean,
you're
I'm
not
sure
a
you guys
fan.
like Bitcoin, but
I
no, it's
do.
not
Yeah.
not fun. It's not. I mean, I haven't been invested in Bitcoin to be honest, but it's just like it's very difficult to price Bitcoin. Why it should be £100,000 or $100,000, $20,000 or $500,000? And that's not something I can quantify. If I don't understand the risk, I don't take the risk. I need to understand the risk to take a risk. I think commodities could look attractive. I mean, don't want to give again any recommendation, but like for example, yeah, some of the commodities, to stay vague, I think look attractive because you have strong demand from global demand now. Especially, you're gonna have, I think, some spikes in demand, which as soon as you get vaccination and the lockdown being over, country per country. I mean, it's not finished at all because we feel it's finished in the UK, but you look at India, it's disaster. But I think the global demand could spike, and that could really commodities could benefit. Equity could keep going higher, but it's already quite high, and maybe commodities is a good entry point. That's what we've seen in the past, as commodities lagging, and if you have inflation, it could hurt the equity market if you have rates going up, but not the commodity market.
Yeah, I've been personally been investing into energy, some oil recently. I have a feeling that's
So
going
you've
to be
done
okay.
well. Yeah, you've done well.
Yeah,
If
I
you've done
mean
that,
some of it has. I think that I read some inflation numbers from the U.S. a couple of weeks ago that it was about 2.5%, and it had been rising up, I think, 0.1% a month, and then
I
it
mean,
had
inflation is, yeah. I mean,
it's
I don't want to give
rising.
a recommendation. Yeah, I don't want to give a recommendation on what to buy, but on inflation, I do think inflation is coming. I mean, you look at 2008, there was a lot of printing, a lot of money printed, but all the money went into the banks to deleverage the balance sheet of the banks.
Yeah.
This time, especially in the US, you went into people's pocket. I forgot how you call those checks that people are getting
Oh,
in the US, but people
stimulus.
buy, yeah, and they use it to buy equity and Bitcoin and everything. So there's a lot of cash. There's a lot of cash. I'm sure people got hurt in this crisis, but not as much as anyone would have thought a
Mm-hmm.
year ago. Now the problem is somewhere else. Is all those SMEs who borrow money and gonna have to repay, and
Yeah.
the end of furlough, and there's other problems to come. But to date, people have been doing okay in
Yeah,
general.
it's a really tough. Yeah, it's a tough and emotional place to be to when you see the markets at such a high level. And I know, so we talk a lot about cryptocurrency too, because it's just something that I've been really interested in. And we have seen this big pullback in the crypto over the last day, and you get this emotional brain trigger that's going, oh, this is never going to rebound. It's kind of like when you see the stock market take a 25% correction, and you feel like in your gut, oh, it's going to take years for it to come back. But honestly, we don't know what's going to happen, and some things bounce back very quickly. Some things take time, but I appreciate your input on that. Anything else you want to say about Blend? I'm going to put the sign up link, by the way, in the chat comment, and you can definitely, I would have a look at Blend Network. I think Yann is doing some really great things, the way that they handle loans over there. And if you hang out after Yann is gone, we're going to talk a little bit about what's going on in the news and some cryptocurrency news afterwards. But anything else you want to tell everybody about Blend and why they should want to come and put their money
Not really.
in?
I mean, I think the numbers speak themselves. I'm not trying really to come here and convince everyone. It's more about giving us the opportunity, and thanks for that, Lawrence. It's about really for people to know about Blend and have a look, and why there's a lot more lenders we discussed than borrowers for sure. And that's I think that's the theme in the world now. There's more people looking for investments and yields, especially product, and it's not just Blend, but clearly I think everyone who's been on Autoland and a bit patient for a few weeks has been able at the end to lend. It's not like you go on it and you cannot lend for 3 months. I mean, anyone, I think on the next loan, especially if it's a big one, everyone who's on Autoland, for example, will be able to lend. The number speaks up. I think I invite everyone to follow us and have a look. They don't have to invest immediately, but keep an eye on how we're progressing, and if they like it, give it a try.
Yeah, one other thing I do want to ask you about, Yann. We've seen every week, it seems to be something about your company failing, a company executive or owner not doing the right thing. And I think it's really damaged the trust levels, and especially of us investors that have been in, since 2012, 13 onwards. We've been invested in a lot of these companies that have gone bad, and that trust has been shaken. What advice do you have for people that have been invested in those defaulted companies and administration companies now? Why would they want to continue trying to find new places to invest within the sector that has gone so badly recently?
And you're 100% right. The market's been, the peer-to-peer terms has been definitely looking bad at the moment. Is looking bad at the moment because of what happened with these companies. I think the problem is it's a relatively new market. Even it's been now around for like 10 years, still, or more even, but since it started, but it's still relatively new compared to banks, who've been around for a lot longer. Banks have been around for a lot longer, so it's still a relatively new market. I think the entry barrier to start a peer-to-peer business 5 years ago was very, very low, and a lot of people started, and there was a lack of professionalism in the industry, and I think a lot has been cleaned out. I think the entry barrier with the FCA getting tougher is the entry barrier is going a lot higher, so I think the market will improve. The advice I would tell to people is really, as I said before, do your due diligence on the platform before you look at the deal, because there's always a risk they try to present a deal better than how the product really is. The project they can make the project look a lot better than it is. So do your due diligence on the platform. One thing we're quite proud of is we have some very high profiles backing us on the board and shareholders, like just maybe I repeat myself compared to the previous call, but we have the chairman of Citigroup Global Markets, who's chairman of Oakland Bank, who's a shareholder of the company, and people can verify that on the company house as well. We have the co-founder of a $40 billion hedge fund based in Geneva now, but based in the UK initially, and the chairman of Publicis Group, which is the third biggest advertising company in the world. So those type of investors, when they came to Blend, they did a big due diligence. It took us a very long time to have them on board as lenders and as equity shareholders. And that can give, in a way, a bit of trust to people to say, if those people are invested, they're very sophisticated, they're ultra high net worth. It brings confidence because those guys know what they're doing. But I'll say due diligence on the platform is very important. When you're in the good hands, I'll say you can expect a good platform to pick the right deal. So obviously, look at the deals; it doesn't hurt, and the more you look at deals, that's great. But it's, to me, more important than looking at the deals.
Yeah, absolutely. Okay, well, there you have it. Thank you again, Jan. I'm sure I'll be
Perfect.
reaching
Thanks.
out to you in 6 months' time and
Sounds good.
inviting you
Whenever.
back on. And
Pleasure.
everybody in the chat has been saying you did a great job, and thanks for explaining Blend. I think you'll probably have some new sign-up customers.
Sounds
And
good.
we appreciate you, and good luck with the business. I hope we continue to grow and continue to offer excellent loans to us and the rest of the investors out there. And
Perfect.
appreciate
Thanks,
it.
everyone. Thanks,
Okay.
man. Thanks, everyone. Have
All
a good
right.
evening.
Speak to you
See you.
soon.
Bye.
Thanks. Okay. There you have it. Yann Marciano. I got to tell you, I always find Yann to be so professional, and he just always does a great job of really breaking down the basics of what is important behind a peer-to-peer lending. And that really, at the end of the day, is the person running it is on the up and up, number one, and number two, that you offer quality loans and that you're well capitalized as a business. You have enough money to float through your growth process that can take several years sometimes. And I think Blend really checks those boxes. I've been up to Blend's offices a few times, and I've sat down with the team up there. Yeah, and to be honest, the only reason I don't invest through them at the moment is because the amount of money that I have invested in peer-to-peer is what I'm comfortable with. To stay diversified, and I think that's important, especially in these times of volatility. So yeah, excellent, and go check them out. Go check out Blend. I think they're really doing a good product. For anybody that wants to stick around, we're going to do a little bit of crypto talk. Whether you're into crypto or not, I think it's really interesting what's going on. We saw this big tweet from Elon Musk, which, I was surprised. I was really, really shocked to see that tweet yesterday. It's funny because he just tends to not to put out these formal press releases like that when he is tweeting something. He just tweets it out. And part of me wondered if he had not gotten hacked, if that was what was going on, if his account got hacked, which I don't know that that's true. But the way the press release was put out, I don't know, hopefully you can see that. See if we can reduce the size of this a little bit. No. Come on. Anyway, the way that it was put out it really threw me through a loop. I was kind of annoyed about the whole thing. I thought that the way that he flip-flopped on the Bitcoin was ridiculous. I mean, surely he knew about what was going on with the electricity, and a lot of the electricity concerns that people are talking about are FUD. That it's not the information accuracy is not always accurate when people are saying, well, Bitcoin uses so much energy. There's thousands and thousands of terawatts of electricity that is wasted and reproduced and never used on anything, and Bitcoin uses a few percentage points of the world's electricity. There's tons of information out there about this whole electricity argument and Bitcoin. If you compare it to gold mining and the production of electric car batteries and how much electricity and fossil fuel goes into making those things, it's a blip on the radar. And this is just really a narrative designed to talk down a new asset class that is going to be so disruptionary in our world. And when disruption comes along, people don't like disruption. They don't like change. The banking system does not want to see Bitcoin really flourish in many ways because it's going to disrupt the banking system. And we have new asset classes that we can invest in ourselves now. Some of them are not going to do well. Some of them are going to do really great. But this whole thing about suspending vehicle purchases, so what was the real reason behind that? Well, it comes out with this news story that Tesla, and apologies that you can't necessarily hopefully see this, but Tesla seeks entry into the U.S. renewable fuel credit market. That was released on May 12th. So what are we today? 13th. We see that Tesla wants to get some money from the U.S. government. And the way that they're going to be able to do that is by keeping their hands clean. If they want to get tax credits and fuel credit markets into renewables, and they're saying we're going to accept Bitcoin, and then the U.S. government comes along and says, well, you're promoting something that uses a ton of bad energy and blah, blah, dirty energy and whatnot, so we're not going to give you any entry into this renewable fuel credit market. Makes perfect sense that they would make this announcement. It also questions, is Elon Musk very stable, in the way that he releases information like that? I mean, this is very damaging what he did. I think he's going to get investigated by the SEC in America for market manipulation. I think it's very dangerous, flip-flopping like that. Personally, in the long run, I don't think it's going to make much of a difference to what's going on with the cryptocurrency market. Everybody is panicking. This is what happens. We've seen it with Bitcoin over and over again. If we look at the charts, look at the charts, we've always seen these ups and downs. 32,000 here, down to 30,000. We've seen these climbs and these dips down, and even if you look back, right here, it's happened here. Obviously, this chart is very compressed, so it doesn't look like a lot, but these dips and these levels of volatility right here, this was in 2017, we saw this big dip. It's going to happen, and personally, this has no effect as far as, I just see it as an opportunity. I mean, right now you can buy Bitcoin at a 10% discount. In 2 or 3 months time, this is all going to be washed over, and the smart people will be buying the coins and the businesses that they think are going to do well in the long run. I mean, you've got some incredible buying opportunities here, even in Ethereum, which has topped out over 4,200 down to 3,600 US dollars. Binance coin, one of the coins that's done really well that I personally own has been Cardano. Payment system up 20% over the week, and even in this bad market up 10% today, over 10% at one point today. So yeah, it's just noise. It's just a lot of noise. Everything will bounce back as always if you stick to the coins that have fundamentally good business models, like Ethereum and Bitcoin as a staple of a portfolio. This is not the end of Bitcoin. I'm personally a long-term believer in what Bitcoin is actually here for and what it will do in the future. Now, some of these other coins, yes, these are gambling coins. Some of them are businesses that are generating a lot of money, like these decentralized swapping platforms like Uniswap, PancakeSwap, where you can take a coin, swap it over into another coin at the right time when the fees are appropriate. So these are good businesses, and they're making a lot of revenue, and they will continue to do so as the world of cryptocurrency extends into the retail market and becomes more widely accepted. These companies are going to make money. Things like the Graph, which is a database, a blockchain database. VeChain, the Chinese cryptocurrency, which rumors are that they're tied into the government contracts. There's a lot of things moving. Chainlink is on a discount today. Solana is on the discount. It's just an opportunity today. So I look at these times and I go in when the markets are low and use it as a buying opportunity. But this Tesla noise is a blip on the radar that will be short-lived, and this, personally, in my opinion, there's no guarantee, of course, but I expect this will wash out, and you're going to see a big uptick in the next few days when money starts to pour back in to especially these big market cap coins, Binance, Ethereum, Bitcoin, Cardano. Doge, not so much. I mean, Doge was always very much a gamble as a joke. I came in at 3 cents. Just kind of as a buy and hold, as a joke. I thought, you know what, this coin, I throw a little bit of money in there and see what happens to it. And right now we're at 38 cents. Who knows what's going to happen with it? It'll probably shoot back up again once all of this noise settle down. And then Polkadot. Be careful, with some of these, like Ethereum Classic is a total split off from Ethereum, completely different coin to what Ethereum is. So and you can find some opportunities in these lower market cap coins to when they really start to bump, 10xing your money. But again, there is risk involved, and some of these are about timing, getting in and out, which I'm not a big fan of. I'm a patient investor, and I try to buy and hold. I try to buy things that I think are going to be holds for 5 to 10 years, and that's really the patient play. You don't want to be looking at this as like a trading game. Trading cryptocurrency is extremely risky and very difficult, just like trading stocks or trading anything. Unless you really know what you're doing and you're an advanced trader, you just don't want to get involved in that. And don't buy into the hype. When everybody else is selling, that's the time to be buying. When everything is shooting up, you start going in then. At that point, that's the time you probably should have some concerns and be waiting for those dipping opportunities in order to buy in. So that's what's going on in the cryptocurrency markets right now. It's pretty exciting. We are going to see some volatility, and it's going to be like that for a while. Nothing has really changed. So let's see if you have any other interesting comments. Again, thank you to everybody for joining. Ken Wallace says, I find it interesting that Elon cited the environmental cost of electricity used to create Bitcoin as a reason for not accepting it for Teslas. Yes, it's funny. There's also been some rumors that maybe Elon is looking to create his own cryptocurrency. Maybe they want to create a sustainable Bitcoin mining rig that's powered by solar. But the amount of fossil fuels it takes to create the batteries that go into Tesla cars is way more problematic than this Bitcoin situation, which quite frankly has been really, really overblown. So, yeah. Yeah, Ken says, where does he think the electricity comes from to charge his cars? And that was a reason why I thought maybe the account had gotten hacked, because it was so left field. And then you saw that US renewable energy credit story come out, and it really started to make sense. Paul says it shows the fragility of a coin if Elon can make such an influence. Not necessarily. I don't think so. I mean, if you look at Elon's Twitter, he's just a huge influence. I mean, you've got a guy who has, let's see here, 54 million Twitter followers. I mean, he's one of the richest guys in the world. He's putting up space rockets. He's very, very influential. He could tweet about a stock. He would get in severe trouble, right, for doing something like that. But he could tweet about a stock, and it would have the same run up on that stock. If he said, go out and buy Apple stock tomorrow, you don't think the Apple stock would rise up because people were piling their money into it? Of course. The problem with cryptocurrency at the moment, because it's unregulated, he can say things like that and affect the price of the cryptocurrency, which is quite dangerous. But anything can be volatile. I'm not really into this argument that only cryptocurrency is volatile. We've seen stocks that have had 25% day losses. So everything can be volatile. Even gold can be volatile. If you look at the gold chart, it's like that. It's like that. So, yeah, I think he could have done not to say that, but whatever. It's Elon is cut from a different cloth. So, yeah, Elon was talking about accepting Dogecoin for his Teslas. I don't even know that he owns any Dogecoin. And my theory about this whole Tesla situation was that, I personally think, and this is just my opinion, that Tesla is going to accumulate more and more Bitcoin, and the way that they want to do that is for Bitcoin to be as cheap as possible. If Bitcoin goes to 100 grand, costs them more to buy it. If he can put out this Dogecoin narrative and get people focused on Dogecoin, the price of Bitcoin, I don't know if you've noticed this, but the price of Bitcoin has been very stagnant for the last couple of months. It just really hasn't been doing anything. You can see here the chart, right? Look, this is the 1 month chart. We've seen a 3 month chart. So very, very little movement. We're at $47,336 February 13th. And right now 54,000, so we had a bit of movement. But along the way, it's been very, very up and down stagnant, which is a great opportunity for somebody who's trying to accumulate more Bitcoin to buy. Right now we're at $48,000. It's a good buying point. So if Mr. Musk can put people's attentions on things like Shiba Inu coins, which are joke coins, and Dogecoin, then people's attentions and money are not going to be focused on Bitcoin. They're going to be focused on these other stupid meme coins, which means that Bitcoin price stays suppressed, and it's a better entry point for them to go into. Again, severe market manipulation, which is a problem. But as you can see here, what's important is to look at Bitcoin's dominance in the ecosystem of cryptocurrency. So 42% weighted towards Bitcoin and 19.6% in Ethereum. So we haven't seen this huge drop off of dominance in Bitcoin's general presence in the cryptocurrency market, which is important. I think Bitcoin is always going to be number one, at least, well, just my opinion again. A lot of people think Ethereum, but as long as the dominance stays high, we've seen it much higher than 42%, but it seems to be just stagnating through. So I think Mr. Musk has some agendas there, which are probably not very apparent at the moment, but they will become more apparent. Maybe he'll get a slap on the wrist from the SEC. Darren says, how long before the SEC goes knocking on Tesla's door? I think it's going to be very, very soon. I think he's going to get a really big slap on the wrist. Ken says, why can't Bitcoin be generated by solar? That's a great point. It actually is generated by solar. So we've got about 70% of all the electricity being used to mine Bitcoins and other coins actually renewable energy, including solar power and wind power. So again, this is one of the misconceptions about how much electricity is actually used to create and mine Bitcoin. So a lot of solar is being used already. Debbie says, thank you, Elon. My crypto is down and my Tesla shares too. Yeah, I got out of Tesla myself at the $700 US. I thought tech was going to really get hammered and moved into the commodities like oil and energy a while ago. Again, not financial advice, just what I'm doing. Debbie said, investigation of the SEC is coming. Absolutely. Perfect. Yep, John, you said it right. Maybe Elon wants to buy some more Bitcoin. I personally think he does. Absolutely. Elon is controlling the world economy, and remember, the guy is one of the richest men in the world, so what he says is going to have an effect. AccuChat, let's send him off to the moon on one of his rockets. Dave, I think Elon is a genius. I love his presentation style. Yes. Do we really know how much energy it takes to mine a coin or make a battery, or are we guessing? No, there's been studies. There's actually a really good video, let's see if I can find it, on this narrative about Bitcoin electricity use. Let's see if I can link it to you, which I think is a good, let's see, it's a good explanation. I don't know where it is, the physics of Bitcoin. I'll have to find it for next week, but there was a great video about the electricity side that Michael Saylor from MicroStrategy is one of the biggest Bitcoin holders. He talks about the electricity usage and really debunks with actual statistics and references as to why the information that we get on the electricity use of Bitcoin is generally tends to be wrong. But I'll find that next week. I don't know where it is right now. Okay, well, here we are. 1 hour and a half. Went way over again. But thank you to everybody. If you hit that thumbs up button and the subscribe, we'll be back here next Thursday. Coming up in June, I think the 6th of June, as far as I remember, we'll have Peter Reed from Assets Exchange on here. We're going to grill him about his business and what's going on. And thank you again. Had a really good time. We'll see you again next Thursday at 7:30 p.m. UK time, 2:30 p.m. US Eastern time. And that's it. That's all I got this week. So take care, and we'll see you next time.